The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate?
It was initially the 12% return, but it quickly turned into the people.
All right, welcome back to another episode of the Multifamily Masterclass. I'm Bart Diehl, the Director of Investor Relations here at Neighborhood Ventures, and today I'm joined by some awesome guests, our CEO, Jamison Manwaring, and our Head of Property Management, Heather Andrews. Today's a really exciting podcast because we're going to be talking about one thing and one thing only, our latest offering, Venture on Colter. So we launched Venture on Colter today, and within the first 6 hours, we're already over $1 million in capital raised. Our target is a $3 million raise, and our max raise is $4.5 million. So we're well on our way to getting there. Thank you to the investors up to this point. So while we're on the topic of Venture on Colter, Jamison, do you want to lead us off with, some of the property details, the story as to why this is such a good acquisition?
Yeah, so let me kick it off with Venture on Colter. So this is our first property in our Opportunistic Fund. It's a distressed property, meaning that it has the prior owner was trying to sell it before the bank took it back. They were not able to sell it before that happened. And we actually looked at acquiring it when the prior owner was selling it over the summer. We didn't make a run at it at that point. Mm-hmm. The lender took the property back. And when the lender took the property back, we reached out to them about potentially buying it. And there was a few other people as well who were looking to buy it. And the prior owner had debt of $13 million, and that was what our offer was. And that's the purchase price that we have it under contract for is $13 million. And so it's a really tremendous opportunity to buy an asset at this type of purchase price, because a few years ago, this was worth 18 to 20 million. And at that time, the prior owner also took some funds from the lender and some investors, and they invested $2 million in capital improvements in the property in the past couple of years. So the prior owner was trying to figure out how to get through it. Basically, the debt amount was higher than what would justify holding on to it for, on top of the money that they had brought in from investors, and they weren't able to cash flow from rents. So they just got in a difficult situation, and then the apartment market has gone down in the last few years as interest rates have risen. So this is an example of the type of thing that we're seeing, not broadly, but with some operators. And we really like the asset. We like a lot of the future upside. Yeah. The fact that it's near I-17, it's near Grand Canyon University, near a lot of redevelopment there, Metro Center Mall. So we loved some of those longer term plans. But the real thing that attracted us to this was that the purchase price is pretty incredible. So it's about $105,000 a unit. And at that purchase price, I haven't seen since I've been involved in the last 7 years in multifamily, I haven't seen this good of a deal ever in that 7 years. So for me, I'm excited about it. I like deals. I love buying stuff on sale that's high quality.
This is our Black Friday
coupons.
This is that's it. This is our Black Friday purchase, and we've been waiting 7 years for it. So we're excited about acquiring it. It's our first project in our distress fund. And then we're also opening it up to individual investors to be able to invest directly to get a 12% annual return. This is similar to how we've done past projects. So we're expecting a 3-year project and 12% preferred return for each of those 3 years. As you said, we're a few hours into the fundraise, so it's exciting. We just launched this morning, and we've raised over $1 million already. So.
And I'll say this. Our investors that didn't invest in the Opportunistic Fund because they like direct deals, this is the perfect fit for them. And they can see that this is immediate $5 million of basically built-in equity being able to purchase at the $13 million debt value. especially with it being valued, just under 20 million a couple of years ago. But yeah, this seems like a great asset. I think our investors are getting behind it. They really like it. Thinking about the property, Heather, what are your favorite features of the property? What are the tenants like there? What are your thoughts?
So I'm really excited about this property. I know
Yeah.
you want to call it distressed, but it is, in my mind, from the property management side, it is not distressed. This is a beautifully maintained property. They've done that $2 million. You can see that he put that money into the property. We're going as a good foundation. The grounds are beautiful. It has 2 gorgeous pools. There's 2 different buildings, nice green lawns. There's room for people to socialize, to hang out, to grill. The location, I think, is a good opportunity. And it just needs a lot of attention. It just needs someone who's really focused. They're full time on just filling up that last little bit of occupancy. And we have someone here, a property manager, that's going to step in, and that will be her focus, and she's good at that. And I think it's not going to take long.
Yeah. And current tenant profile, is it blue-collar workers? Are there students there? I know it's close to GCU.
So we have an excellent neighbor in GCU, which I'm so glad, because they keep that area beautiful.
Yeah.
They keep it quiet. We benefit. They're really our next door neighbors. Their security service. I think this property, though, really lends itself to the people who live and work in that area already. There's a lot of opportunity for outreach to a lot of small businesses. There's salons and barbers, and there's grocery stores, and a lot of car dealerships.
You have
And
the new development of the mall coming up soon.
that Metro
Yeah.
Center, I think, is going to be a big push.
Yeah.
Because that light rail's coming right in. I think that's where the people who want to be close to where they work are going to really love this property. It's very kind of all-inclusive. The utilities, all included. And we make it easy.
Yeah.
You can come home and rest, and then work's right there.
And you're talking about GCU being a great neighbor. When I was driving around there with John last week, and we saw GCU students riding bikes picking up trash
Yep.
around the property, and I
They
thought that was
care
the
about
coolest thing.
Yeah, they care about their property.
Yeah, so it's really exciting. Jamison, what are your thoughts on the property? What are your favorite features? What do you like about it?
Yeah, I think that Heather touched on the important stuff, and she brings that perspective as a property manager, knowing what people are looking for. It has about half of the units are studios, and then half are 1-bedrooms. So that tenant profile is a little bit different at every property, and that's this property. It's 1-bedrooms and it's studios. So there's going to be some couples that live in there. There's going to be single people with pets.
Yeah.
Not too many families, but given the location right in the middle of town next to the campus, I think it makes a lot of sense. And yeah, when we did the tour, we had driven by it prior, but when we actually did the inspection and walked through all 123 units, we opened the doors and we went in every unit, which takes a long time, but you really only get one chance to do that. So we did that before we bought the property. Or before we haven't bought it yet. It's under contract right now. Before we put it under contract, and as we did the inspection, I was pleasantly surprised by how it looked. Especially the exterior is really nice.
Beautiful.
They have these courtyards that have swimming pools and green, and the aesthetics look really well, really good. The infrastructure, so this has what's called a chiller system, which is popular in Arizona to cool large apartment buildings and hotels. And in fact, a lot of hotels still have them, and apartment buildings do, like this one. It's a big, expensive system, and we didn't know what the status of that would be. And it looked, as we inspected it, it's actually in really good condition. So we're happy to see that. And the infrastructure and some of those big expense items, it looks good. So we didn't know if we would go in there and have really old, not well maintained infrastructure, but it was in good condition. So we were really pleasantly surprised. And yeah, I think that for an investor now, and as they start to look at what are their options, and this is the kind of conversations that I'm having in the calls that I'm having with investors is, the stock market has really ripped the last few years.
Yeah.
So sitting here in December, the stock market's up, NASDAQ's up 25%, the S&P's up the same. And it was also up the same last year. And let's go back a few years. In 2020 and 2021, multifamily was up 20% and 20% back-to-back years. And then in 2022 and 2023, it's come back down. So just remember, with investing, you're likely going to have some rebalancing of these values in the stock market. And I think a lot of investors are really asking the question now, as they get to the end of the year, do I rebalance my portfolio? Should I pull some out of the stock market? And where real estate's at right now is in a really good position because it's come down. So you have an opportunity to invest in an asset like Colter now here in December at the end of the year to reallocate some of your funds into real estate. Some people invest 100% in real estate, but most people should have at least 20 or 25% of their portfolio in alternative assets like real estate. And that's the conversation, kind of the higher level conversation. You have a macro conversation with investors, and then you have a micro conversation. The micro is, this property is great, and we're going to talk more about that.
Yeah.
I think as we get to the end of the year, a lot of people are starting to look at, okay, well, where does the stock market go from here? Is it going to go up another 20% next year? In my opinion, it's not. I wouldn't expect that. It might still do okay. Maybe it goes up 8 or 10%. And there also could be a correction. And I think that's where people are looking at opportunities like this to reallocate. So I think Colter is a great opportunity because we're acquiring it at a really low basis.
Yeah.
And anytime you can invest in a good asset at a low basis like this is actually really unique.
Yeah.
It's a great asset in the middle of a fast-growing Phoenix, and you're buying it cheap.
I know
That's rare.
I know it's implied, but what's your expectation for values over the next 3 years? Because that's the whole term for Colter.
For apartment values are different than single-family residence values. Single-family residents have not gone down in value over the last few years, even though interest rates have gone up. So single-family, which is what we're all more familiar with because we can always look it up on Zillow if you own a home, or look up your friend's house on Zillow. We kind of know where single-family homes are when it comes to those values. Apartment buildings are a different animal, and most people don't know that apartment buildings have gone down in value 20 to 30% in the last 2 years.
Yeah.
It's a significant drop-off that we haven't seen since the great financial crisis in 2008. So as those values have come down, the real opportunity is to go try to buy assets right now. Buy low, sell high. So
I've heard that before.
yeah, that is the best advice, financial advice ever given, investment advice ever given. The hard part is actually doing it. But this is an opportunity to buy low because it's gone down. We think that it's hard to predict all of these things, and it's hard to time the market. But because we're acquiring this at a low entry point, and Heather and her team, our operations team, is going to go in there, and we have about 25 units to lease up. So we're 80% occupied. So there's some work to do from an execution standpoint, and our team's going to go in. We have about 6 months to get to full occupancy, and Heather's shaking her head saying, yeah, we can do that.
Yeah.
And then once we get to full occupancy, then it's just about continue to operate it well. But that's why part of why we're getting a good deal on it is because the current owner, the prior owner, went through several property management companies. They were never able to get to full occupancy. They were finishing some of their renovations, and it is not easy to do that all at the same time, and they weren't able to. So we can come in, we don't have to do any renovations, we just have to finish the job, get it fully occupied, which is about 95% occupancy is considered fully occupied in multifamily. We get it fully occupied, and then we just run it for a while. And I think we will see recovery in those values. It might not be worth $20 million in 3 years, but I think in the next few years, we're going to see interest rates will come down and rents will move up.
Yep.
And as both of those things happen, even if one of those things happen, values shoot up quite a bit with apartments. If both of them happen over the next few years, then that's when you see a lot of value creation in apartments. So we think we'll see a lot of value created in this asset over the next 3 years.
Yeah, and we're talking about getting the property, over 90% occupied. So that's a key milestone. Are there plans for refinancing after that? What's it look like? What are some key milestones and metrics we're excited to sharing with our investors over the next 3 years?
So I can tell you, starting at this 80%, the feedback we've gotten with the current property management company that's there is that we already have a very solid base. that these are residents who care deeply about their property. They're very committed. So we're not coming in, we're able to just move up. We're not having to kind of backtrack. We don't have people leaving.
Yeah, and I think
think-
that's important because we've had other projects where we do have the tenants move out
Yeah.
because we're renovating it and the rents are moving up. We're not dealing with that here.
And I think the rents right now, there is some room to move up. I think we have, because we can offer all the utilities, including internet, as part of the package there, that also makes it really attractive. There's some ways to add value that way. It really, so much of it, I think, is just outreach. It's just a lot of focus, going out into the community, letting them know we're there. And I think it's going to fill up very quickly. And then as you have your tenants there, you can kind of slowly, we're fairly conservative in how we raise rents. We're careful because we want to keep good tenants, but it's going to keep moving up over the next few years.
And rents go up with the market.
Yeah.
So you can't arbitrarily just raise rents and have people stay.
Yeah.
They will go up as the market rents go up in the greater Phoenix area.
Fair.
And this is an affordable place to live.
Yeah, it is.
You can get a studio for around $1,000, and that includes internet. Is that right? About $1,000.
About 1,000.
And then a one bedroom is another 150 on top of that ish.
Priced similar to Country Club. It has a
Or other
lot of
pro-
similarities to a property we've already been running for several years. So we already have a lot of experience with kind of how this property is set up. The thing I like about having these studios and one bedrooms is that we have a variety of unit types available. And these people that are coming in, we can grow with them. So they may be starting out a single or just a couple, but as their family expands or their career expands, we can keep moving with them through our all our different properties, our property portfolio. And so I think there's a lot of opportunity just to kind of have more people into our venture residences family and keep them long term, no matter which property they're at.
I think that's an important point with property management that has been a great thing that our team has done is if people have a good property manager, it's actually pretty rare. There's a lot of horror stories with property managers MIA. They don't fix anything. They nickel and dime us. They're not communicative. And so we do a great job of realizing that this person who is a tenant, a resident at one of our properties, they're the ones who actually make everything go.
Yeah.
Because we need to collect, once they pay their rent, that's how everything gets paid for. So we treat them.
Pay our mortgage. Yeah.
Yeah, we treat them like a highly valued customer.
Yeah.
And I think a lot of times they're not treated that way by a lot of the big property managers. And then when they do want to move from a studio to a one bedroom to another side of town, we have
We
about
want
10
to grow with
properties
them.
across the valley, and we move them to those
And
other
our
properties.
residents do that quite often. And it's kind of exciting to be part of their next step. And they refer their friends and family, and that's really what we're trying to create. That's the community we're trying to create. So it's not just one property. They're all very much tied. I'll tell you, our maintenance is a big plus. We have an excellent maintenance team, and that's one of the biggest predictors on whether someone renews, someone decides to stay at a property. And that's where we really excel, is how responsive and how much our guys care about our properties. Because we're also the owners, all of our attention goes into these properties.
And for those watching online, when you guys log into the Neighborhood Ventures platform, you click on the offerings page. On the offerings page, you'll have Venture on Colter, obviously, but you'll be able to see what the current rents are and what the market rents are in the area. I know we didn't have a firm answer on that, but go online. We'll link it in the description, and you guys can check it there.
Yeah, about 1,000. But
Yeah.
but to Heather's point, we're not trying to take rents really high. They're pretty close to where we expect them to be now. But over the next 3 years, they will be moving up is what we're expecting.
Yeah. So the last thing I want to touch on is the exit strategy. So obviously it's a 3-year hold. Jamison, what's the plan for exit? Is it a property where is there a strike price? Is it a property we're selling to a third party? Is it a potential UPREIT candidate? What's that look like?
Yeah, that's a great question. So we always have a plan when we acquire an asset of how we're going to get out of the asset. So it seems like different than when you go into a marriage. You're not planning the
Maybe
exit.
for you.
But when we go into an asset, we have multiple plans and multiple exit strategies. The first one, plan A, is we plan to sell it once we've achieved around 150,000 per unit market value. So we know we're buying it at a discount today. We're expecting over the next few years we're going to see rents move up, interest rates go down, and that's going to help us achieve that 150. And we think that's very achievable. It was more around 170 to 180,000 a few years ago per unit. So we think that's kind of a solid double, and it may even be better than that in a few years. That's plan A. Plan B is it might be an asset that we want to keep longer, and that is when we would do an UPREIT strategy. That's when essentially the REIT, the NV REIT, buys the property, and there's some great tax advantages to investors there. That is most likely not going to be the plan here, but it's plan B. Plan A is to sell it to a third party. Plan B, if we really like the property and we want to hold it for another 10 years, then it would qualify to go into the REIT. And for it to go into the REIT, it has to be generating cash flow. It has to be stabilized.
That's always my secret hope. I'm attached to them all.
Yeah.
I'm going to make it so successful. We'll not be able to let it go.
And we may get to that point. We may say we really like this asset and we see more juice down the road over the next 10 years. So that's plan B. So we have a few exit strategies, but plan A would be to sell it to a third party, and that means investors get their principal and their returns back when we sell the building. The other thing with this offering is during the first year, we aren't expecting today to pay distributions during that first year. That can change. If the property gets leased up quicker and we're generating profits, we will start sending distributions before then. But our plan right now is beginning in year 2 to start sending distributions to investors. That's because at that point we would have it fully leased and we're operating at a high level. And as profits are coming in, we want to send that money back to investors as quickly as we can. Yeah. So in years 2 and 3, we would be sending distributions back to investors, and that's always fun as an investor to start getting out those first checks. And we do that every month on the 10th of every month. So that's part of the exit plan. And I think that the other part of it we've touched on is just what's going to be happening in this area over the next few years. Our big neighbor, Grand Canyon University, they may or may not be someone who buys this building down the road, but they have bought a lot of apartment buildings in that area. That isn't our exit strategy, but down the road, is it likely that they could buy this building? I think is probably, but it might be in 10 years, it might be in 3 years. The other thing is a few miles to the north with all the redevelopment, the Metro Center, and the light rail that now comes over there. That's going to be completed over the next couple of years. So it's just starting now. You know, they're tearing things down. The light rail just connected over I-17 into that hub. So a lot of stuff's going to be happening there over the next few years, and that also helps when we go to sell. Those things all add to what the value of that building is at that time. Thank you for listening to our podcast, The Multifamily Masterclass. Please subscribe to get all of our new episodes.